Index funds are some of the most powerful tools ever created when it comes to investing in the stock market. I've been using them for years to help grow my investments, and they've taken the world by storm over the past few decades. However, as amazing as they are, and as simple as you might think they are to use, there is still a lot that people get wrong about them. So in this video, I wanted to go through a few of the biggest mistakes that I keep seeing investors make and explain how you can avoid falling into them if you haven't yet started. Let's start from the top and work our way through. First up, index funds can come in lots of different shapes and sizes, but one of the most important things to know is that there are two main categories that an index fund can fall into. I see people make this mistake all the time, and it's a question that I keep getting in the comments section a lot too. So just imagine this, as it will all make sense in just a second. Index funds are just a category, and inside of that category, you get two different ways you can make your investment. Those two ways you can buy index funds are in a mutual fund or something called an ETF, which stands for Exchange Traded Fund. Now, both of these can be index funds, and everything inside of these funds can look identical, but there are a few details that can make a big difference. Think of it like this. Imagine you've gone to a bakery and you asked to buy some bread. The baker says you've got two options. There's some pre-made stuff over here from Hovis, which is already packed and sliced up, the same as you could buy anywhere. If you buy that, the price is on the packet and you can go back home happy. Or your second option is you can have the baker cut you up as much as you like of his own loaf up to your own budget. Now, either way, you are leaving that bakery with bread, and this is similar to what happens when you buy an index fund. If you buy an index fund as a mutual fund, you normally have to invest a minimum amount of money, but let's say you invest £200 into the fund. Once you place the order, you will get exactly £200 worth of that fund. The mutual fund provider gives you your share and you walk away happy. Now, on the other hand, an ETF is traded exactly like any other share on the stock market. So for example, the price of a share of one ETF might be £105 per share. If you want to invest £200, you would end up with one share of that fund and £95 left in change. This is a common mistake that I see quite often, and people ask me the question why they have so much spare cash in their investing account when they wanted to invest it all in a certain index fund. Well, that's your answer. Mutual funds are sold through platforms and only bought and sold once per day, whereas ETFs are traded on the stock market and you have to buy them in shares. Now, there is one final caveat to this point, and it was only in recent years that this problem's pretty much been solved. Newer investing apps now let you buy fractional shares, which include ETFs, so this problem is no longer an issue. However, this is not available on all investing apps and platforms, so you still might come across it. For example, if you use Vanguard or Hargreaves Lansdown, then you will encounter this issue as they do not allow you to buy fractional shares, so you might be better off using a mutual fund. Anyway, if you do want to open an account that allows you to buy fractional ETFs, then feel free to check out the links in the description to the apps that I use. You can get a free fractional share or even some cash to get yourself started once you deposit and open an account. Okay, moving on to point number 2. Another big mistake I see is people doubling up or overlapping their index funds with each other. Now, I think we've all done this in the past, and I'm guilty of this one as well. You might start off investing with one or two investments, then over the years you end up with half a dozen or so different funds and you have no idea how you got there. I totally get it, and I can see how easy it is to get done. Now, I want to make it clear here that there is no right or wrong way when it comes to investing. There's only what's right for you. However, I do think it's important to at least understand what you're investing in and the effects that this mistake could have on your investing portfolio. For example, here's probably the biggest and most common one that I see that gets brought up in conversations I have. Let's say you have two funds in your portfolio. You have a global index fund, maybe something like the Vanguard FTSE All-World ETF, and then you have an S&P 500 index fund, which could be something like this one. You've decided you want to have 50% of your money in each fund, as you've been told how great the S&P 500 is, but you also want to make sure that you diversify around the rest of the world. This all sounds perfectly reasonable until you really start to think about the issue that this could be bringing up. So again, let's think about this in terms of food, mainly because I'm hungry, but it might also help visualize this problem a bit better. Imagine a global index fund is a perfect pepperoni pizza. It's got the dough, the cheese and tomato, and then the perfect amount of slices of the pepperoni all arranged neatly on top. It's almost never how they arrive when they get them delivered, but stay with me on this one anyway. Now, a global index fund is like that perfect pizza. It's got almost every single stock in the world in it, arranged by their market cap, which is just a fancy way of saying that the bigger the company is, the more of your share of the money they will get. For example, as of today, the top stocks inside this FTSE All-World Index Fund are Apple, Nvidia, Microsoft, Amazon, Meta, and so on. All of the percentages are listed here, and this is the amount that will be invested for the money that you put in. This is almost like the ingredient list of our pizza. So the moment we start changing this and adding parts, we can end up with something that looks different. Compare this fund to the S&P 500 fund, and you'll see what I mean. The S&P 500 fund is only going to have stocks which are based in the US, and is limited to the 500 companies that S&P have chosen at any point in time. Now, check this part out. If we compare the two, what do you notice? Well, clearly, the S&P 500 fund is way more concentrated in those top few stocks, and that means more of your money is going to end up with these companies. In the past, the S&P 500 has obviously done really well, and there's no denying that it's been an amazing performer. Anyway, when you mix a global fund with an S&P 500 fund, all you end up doing is putting more money into those top US stocks. This could be a good thing or it could be a bad thing. I have no idea how it will turn out. But I do know that not everyone realizes that a global index fund already has those large US stocks inside of them. In my view, I'd rather be globally diversified, but that's really a decision you have to make. Just be sure that you realize what your portfolio actually looks like when you end up having a few different funds, as it's so easy to overlap and end up with a bit of a monster. The biggest issue is then trying to figure out how much you invest each month. I mean, say you had 4 funds, do you split the money equally or do you split it up differently each time? In my view, I think we've got bigger problems to worry about and we should keep our investing simpler. I might even make a whole video on this issue, but for now, let's move on. Okay, point 3, this is an easy mistake to make, but you need to know that index funds will often come in 2 different versions of the exact same fund, as if investing wasn't complicated enough. Now, the differences are pretty simple to understand, and it might explain why you have some extra cash in your account that you weren't really sure where it came from. So let me just explain using a quick example on screen. Here's a popular Vanguard index fund with a ticker symbol VWRL. As you can see, there's a little part of the name at the end of the fund that says DIST, and this stands for distributing. What this means is that this index fund will take all of the dividends that it receives from the companies that it owns, and it will pay those out to you as cash. You'll get this payment every 3 months into your account, and the more shares you own, the bigger your payment's going to be, as it's just based on a percentage. Now, if you're a long-term investor and you're trying to build your wealth, you might not want those dividends or be expecting them at all. Instead, you'll want to reinvest them, or better yet, not even have to worry about them at all. Now, some platforms make reinvesting dividends really easy, like Trading 212 here. However, other ones might end up charging you fees to do it. So here's where the other versions come in. For this specific fund, the other version can be found here. It's VWRP. And now you can see another little note in the name. This time it says AC or ACC. This stands for accumulating, and it means exactly that. Every time a dividend is paid into that fund, they reinvest all of that cash so you never have to worry about it. I personally find this really useful, as it means that you aren't sitting holding loads of cash in your investing account waiting for it to be reinvested. On some platforms, dividends are even paid and you don't even get told about them at all, so this stops any issues like that. Now, it's totally up to you what you want to do. For some people, you might actually want the dividends as you're using it to pay your own bills or get retirement income. However, for most of you out there trying to build wealth in the long term, I'm going to guess that you just want to keep your money invested and get it invested for as long as possible. So just look out for those little names and check if your fund is a distributing one or an accumulating one. It's very easy to make a mistake and pick the one that you don't actually need. Right, moving swiftly on, the point I wanted to make here was that not all index funds are created equally. I know, more complicated stuff to worry about when you thought they were meant to be simple. Here's where the devil is in the detail, and you need to look out for a couple of key little points. For example, just because a fund name has the word world in it, doesn't mean that the fund invests in the whole world. I'll show you on screen now what I mean. This fund here, managed by UBS, is an MSCI World Fund. So you might assume that it invests in the whole world. However, that's not the case, and you can see here that the MSCI World Index actually tracks the developed world only, which is made up of 23 different countries. What this means is that you could be missing out on the rest of the investing world in the developing markets. Now, like I've said before, there's no way to know if leaving out the emerging markets will be a good or a bad thing for your investments in the long run moving forward. However, I do think that it's at least important to know what you're investing in and what kind of index your investments are trying to track. Although the emerging markets might only make up about 10% of the whole investing world, What if they end up being the best performing kind of investment over the next few decades? Now, personally, I'd rather make sure that I own everything, but as always, it's completely up to you. To avoid this mistake, here's what I would always do to make sure that you know what you're investing in. Before I make any investment into an index fund, I'm going to double check a key bit of information that should be supplied by the provider that you're buying it from. It's called the Key Investor Information Document, sometimes shortened down to KID or KIID. And I'll just quickly show you where it is on Trading 212, but all providers will have this information. You go into the investment itself, scroll down to Instrument Details, and then you'll see a link to the Key Investor Information. When you have that open, you can then have a good read to make sure that this investment is going to do exactly what you expect it to do. For example, here I can see that the fund is tracking the FTSE All-World Index, and this includes developed countries as well as emerging markets. I also see that this fund will pay out any income from dividends to you if you were a shareholder. There's lots more information in there as well, but this can be for another video. The key point I wanted to make here was that it's worth just doing a bit of digging around to really make sure you know what you're investing in. Otherwise, you might get a few years down the line and realise that you've either been doing really well or really badly when you compare your performance with the rest of the market. Let's hope it's the first option, as that would always be a nice problem to have. Going back to my food analogies, this would be like picking up your item in the supermarket shelf and checking the ingredients just to make sure it's got what you expect. Now, I'm allergic to nuts and high investing fees, so I always have to check before I head to the checkout. Your investments cost a lot more than the pack of flapjacks, so spend the extra time before buying them and don't make this mistake. Okay, a final mistake that investors are making with index funds is directly linked to the last point. Don't just focus on fees or any one single factor. Index funds made themselves really popular for a couple of reasons: low fees and great performance when you compare them to those highly paid active managers out there. However, because they've become super popular, there's now so many funds out there that are all competing for your hard-earned cash. One of the ways they're doing this is to advertise themselves having really low fees, or at least the lowest fee when compared to their closest competitors. If a fund is identical to another and the only thing different is the fee, then sure, you're always going to go for the one with the lowest fee. It's no different than if you're comparing the exact food item from different supermarkets. There's no point paying 20 quid for Bailey's when it's now on sale next door for £10. Now, index funds are a bit more complicated than that, and there are loads of little details that you might want to consider before you make your choice. So yes, fees are important and they're right up there when you're making your choices, but so are all of these other points. For example, here's a few other things you might want to look at and consider. Firstly, check the fund size, see if there's lots of money invested compared to other similar funds. It might be quite a new fund, or it could be one that's been going for years. If a fund is really small and you end up with a big investment, it might be difficult when you want to sell the fund or buy more of it. Secondly, what about other factors like whether a fund is using physical replication or synthetic? There are pros and cons to each one, but I bet most people out there would have no idea of what the difference really is. And then finally, without going into too much detail and covering off these all one by one, it's also worth checking the domicile of the fund. This one says it's based in Ireland, which can come with its own benefits. However, you might also see others based in the UK or somewhere like Luxembourg. The devil is in the detail in this one, so if you want a video going over these, do let me know in the comments section. Also, if you've enjoyed the video so far and you're not already subscribed, please do make sure you are. It's completely free to do so, and it helps me make more content like this. Anyway, there's 5 index fund mistakes for you. I hope you found that useful and learned something. To keep finding out more, watch this video next. I'll see you in the next video. Happy investing.